Imagine earning income from your favorite stocks even if they don't move up. Sounds too good to be true? It's not. In this video, I will show you exactly how I do it using a simple but powerful option strategy called the wheel. And I'll walk you through a real life example using the SoFi stock. If you are new to options, don't worry. By the end of this video, you will understand how to generate weekly, monthly income with options, protect your portfolio from big drops, build a repeatable strategy for long-term wealth building. So let's break this down step by step in plain English. Welcome to Streetwise Economics. I'm Isaac Jonas, and on this channel, I help traders and investors simplify markets using data, strategy, and common sense. In today's video, this is going to be one of my most requested topics that I've chosen to address: how to make consistent incomes with options using the wheel strategy. We'll cover how it works, when to use it, the risks, and why it's a strategy that even beginner traders can master. I will be using SoFi Technologies, ticker name SOFI, SoFi, as a real world example. It's popular fintech stock that I personally trade for cash flow. So stick around till the end because I will also explain how you can scale this up into a system that pays you while you sleep. A quick disclaimer though, this video is for educational purposes only. I'm not a licensed financial advisor. Trading involves risks and markets can change quickly. Always do your own due diligence and research and never risk money that you can't afford to lose. So let's go on step number one: understand the stock. Before selling any options, the first step is research. For SoFi, I look at their business model, earnings reports for the past couple of years, free cash flows. Do they have a strong balance sheet? And I look at the cash and cash equivalents for at least the past 5 years. The free cash flows, I do the same analysis, and I like to see a growing free cash flows trend so that I will be assured that this stock has a strong balance sheet. And I don't like to do this strategy on stocks that don't generate profit. I want profitable businesses that I really understand how they operate and with a good management. So far in this case, it ticks all those boxes. So SoFi, like I said, is a fintech company helping people to refinance student loans, invest, and manage money digitally. Most people in the US, they use it for, even now people use it to invest in the platform, and they are growing and coming up with scalable and very interesting offers to their clients. So having understood that, I then go to the point where I then have to implement the strategy. So right now the stock is trading at around just over $28 per share. So we showing strong user growth, but also volatility, which is exactly what I want. Stocks with a lot of volatility, in other words, that moves up and down swings, they usually have what is called a high implied volatility. For me, that's a plus because then I get to make more money when I sell contracts, because that high implied volatility there, it has to be compensated by high premium. Premium is what you get now when you sell options, or pay when you buy options, but now I'm talking about selling options. Now, that volatility, like I said, is options. In options is what I like, and that's where my income will come from. Now, having given you this background, I then move on to step number two: wait for the right entry. Timing matters. For me, I usually use indicators like the Bollinger Band for my entry decision. So the Bollinger Band basically tells you the bandwidth within which the stock is expected to trade within by the market makers. 95% of the time, from my experience, it's usually in that range. So that means 5% it might go out of that range. So there's that possibility. So once I see that this stock is oversold, it's at the bottom of the Bollinger Band, then I then prefer to sell the puts when the stock touches or dips below that lower band of the Bollinger Band. That's when the price is usually stretched to the downside and due for a rebound. And I also want to buy only on a red day when it will have pulled down. And then this gives me a better entry to help me to collect premium safely. What that means is now it's highly likely that the stock might potentially bounce back. There is also a possibility that it can still go down further. Now, step number three, I then sell a cash secured put. Here is where the strategy starts making money. When I sell, let's say I sell a cash secured put with a strike price of $26. Let's take, for example, $26. Current price is, let's say, slightly above $28. So I then have to have 2,600 in my account. And I like to take, let's say, 1 month out. I'm just going to take, let's say, uh, December 12 as the strike price. And let's say I collect $46 per share. That is 146 for one contract, since one contract for the options has an underlying unit of 100 shares. Now, two things can happen. If SoFi stays above $26, the option expires worthless. I keep the $146 premium as profit. Now, if SoFi drops below $25, I get paid, I get assigned the 100 shares at that price, but I still keep the premium. Remember, I collected $146 for one option contract. So it's like being paid to buy a stock that I already like to own at a discount. Then I move on to step number four, sell a covered call. Let's say now I have those 100 shares at $26. I then sell a covered call, and let's say the price is still now around $25 and I got it at $26, like I said. Now I can take, let's say, the strike price of $30 1 month out. And let's say I get paid $50, and that is 150 for one contract in terms of the premium. Now, if then SoFi stock then rises above $30, my shares get called away. In other words, they get taken, but I make $400 from that 26 to $30 move. That's $400, right? And then plus the premium, in total 146 I collected first when I sold the cash secured put, and the 150. So in total I make that amount. So if SoFi stays below $30, I just sell another call and repeat the process. I sell a covered call above the current strike price, so that even if it moves up, I still have profit. So that's why it's called the wheel strategy, because it keeps spinning. So step number five, I then just keep the wheel turning. This strategy in this process create consistent cash flow. You sell a put, collect premium. If assigned, you sell a call, collect premium. And the best part though is you can do this every week, every month, even 6 months, because the idea is you want cash flows, right? So I like to do it 1 month, 30 to 45 days. For me, that's what I've seen. I'm comfortable with that range. And the more capital you have, the more wheels you can run. That's how traders build passive incomes without consistently watching charts every day. And I must say, though, that there are risks and benefits, of course, like in anything that happens in the market. Let's talk about the risk reward ratio. The benefits are that you earn steady income through premiums, you buy stocks at a discount, stocks that you actually want. You lower the cost basis over time by repeating this process. Now, on the risk side, if the stock crashes far below your strike price, you may be stuck holding that stock, those shares for a while. And that's why I only use this strategy for the companies that I otherwise believe in their long-term potential, like SoFi as an example. And you can imagine if I have 10 companies and let's say I can repeat this process across these different stocks. Now, with enough volume and capital, you could literally retire on this strategy because earning options income every month can give you that free cash flows that you want. If it's how you approach long-term building wealth, it's how, in my view, I like to approach long-term wealth building. Cash flow first, capital gain second. If you found this video helpful, hit the like, subscribe button to this channel and visit www.streetwiseeconomics to join our monthly community and coaching programs. And remember, we don't chase hype, we build systems that work. That's how you win the long-term game in investing. Thank you, and I'll see you in the markets. And don't forget to like and subscribe on this video. Bye bye for now.